You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Welcome back to another episode of The Builder's Mindset. We talk about real topics and how they impact your business and what's going on in the housing world. I'm your host, Mike DiGiovanni, and today we're talking about something that we haven't heard in a little while, except you've heard it from me, and that's hope. Hope in the marketplace. I want to talk about that from the new American dream perspective, which buyers are showing signs of life. And, I've been long time optimistic, so you're going to hear the hope from this side of things. Don't think we're in for gloom and doom. I think a lot of people are still wondering if we're going to hit a big recession and not just a dip. I was talking to a client of mine yesterday, and that's what he was saying. Just worried about if a real recession is coming. And I said, well, we're kind of sort of rolling through a little bit of one right now. We've been in a new environment, in my opinion, since March of 2020 when COVID hit. At least for those of us in the housing industry. I asked another client of mine recently, I said, when do you think the housing market rebounded? And he said 2012. And so I said, depending upon where you're at, some people think it's 2013, maybe even 2014. But that puts us wherever, let's just say we pick that middle number, 2013, that puts us at about 12 years into the cycle. And we haven't really had a significant down. As we've talked about in prior episodes, the home building industry typically goes in sort of this 7-3-8-2 cycle. You have 7 or 8 good years and 2 to 3 not so good years. It's been that way for quite some time. And that's not what's been going on in the last decade. We've just had a quarter or 2 quarters here or there that feel soft. And then I would say in the last 9 months, so now we've kind of had about 3 months, in my opinion, of pretty soft, where it's like, you got to pay to play. If you're a home builder right now, you have to pay to play. What do I mean by that? I mean is that if you want to sell houses, you've got to pay. You got to pay for incentives in some way, shape, or form. And today we're going to talk about mortgages and what we're seeing in the mortgage area as it relates to this market and where we're seeing signs of life. So I say hope in the market. Don't get me twisted. Don't get it wrong. Interest rates are still up. Inflation is still sticky. It's not dead. And affordability is the major challenge of the day. If you listen to the Lennar or the KB Q2 earnings call, you heard that. We're seeing some real movement though. And not from investors or flippers. We're talking first-time buyers and move-down buyers who are currently starting to find their way back into the market. So here's where here's the hope. That's what I'm saying, hope. So what's changing? Let's break it down. So we just hit summer. A couple days ago was the first day of summer. So we always talk about the spring selling season. But summer is a good sales window too, particularly for those builders who have spec homes. And we recently read an article by the Mortgage Bankers Association, their weekly mortgage application survey. And if you've looked at it, you might have noticed some things. Applications are trending up. Applications, not skyrocketing, but they're steadily climbing. According to the Mortgage Bankers Association weekly application survey, applications are rising, particularly among first-time buyers and move-down buyers who have been sitting out for the last couple of years. Interest rates for 23 and 24 have stayed high, particularly in that 6 3/4 range, we'll call it, just give or take. That's where that pay-to-play comes in. Builders have, since that point in time, when interest rates got to 7% in 2022, October of 2022 to be exact, buyers have been incentivizing, or builders have been incentivizing buyers to bring that mortgage rate down. We see everything as low as I've seen 3.99. I was just talking to somebody that D.R. Horton in the Southern California market is getting rates down to 3.99. So a lot of builders are doing 4.99. Some are doing 5.99. It's they're doing what they need to do, paying to play. Okay, so in Redfin's most recent buyer activity data, it backs this up. They're showing increased search activity and saved listings. That's it. Increased search activity. That could just be hopeful, but also saved listings across key metros, especially among households earning $75,000 to $125,000. That's your first-time buyer, and that's your move-down buyer. Let me clarify real quickly about move-down buyer. So your move-down buyer is, we've all heard a lot of talk over the last, couple decades about active adult. Move-down buyer, in my history, is specifically used to terminology when you're getting to that empty nester, maybe really close to retirement, and you are moving down. You're typically not keeping your first home, and you're moving down to your forever home. It's typically you're looking for something smaller, often low maintenance, that's affordable. Okay, so typically for me, when I say move down buyer, I'm talking about the getting close to retirement or early retirement buyer who's looking for something that'll hopefully get them either a lower mortgage or no mortgage. So those two buyer types are showing increased signs of search activity and saved listings. So what does this mean? So builders that can combine affordability and lifestyle are starting to see traffic return. And that lifestyle can also get creative from, the amenities that you put in a home or community, and or where you build if you're in certain areas that offer access to really great existing outdoor infrastructure like parks and recreation. You can get really creative with how you do that. And so that was reported in the Mortgage Bankers Association weekly application survey, is they reported specifically that builders who are able to combine affordability with lifestyle are starting to see better foot traffic. It's not epic. It's a quiet comeback, but it's real. And let's dive a little bit deeper into the why. All right, so creative financing, we talked about this. We're really seeing, and I saw this recently, but we're seeing that, some people are not waiting for rates to drop. They're accepting the fact, as I've said, I truly believe rates are going to stay where they're at. I believe the Fed will drop rates twice this year. I'm a little bit more of the belief, because I think some of the governors of the Fed have started to decide with Trump that we need to bring them down. I highly doubt we're going to see 2 half-point drops, but we might. And one of the last episodes I said I forecast 2 quarters. I think that's a given. So I'm hedging my bets and saying we're going to see a half and a quarter. I think the next rate drop will be a half. The one after that will be a quarter. And then we'll go into 2026 and they'll maybe do that again to kind of see what happens. But what we're seeing is builders are getting even a bit more creative in their financing, because the mentality is hopeful that rates will come down, that we're starting to see sort of these 3-2-1 type buy downs. And that's like where your year 1 is 3% lower, year 2 is 2% lower, and year 3 is 1% lower. And I've seen some talk about, and then beyond it goes to market rate. But what I've seen, and I just saw this, KHOV had advertised on their website that it was KHOV? Yeah, I believe it was KHOV. Maybe it was, yeah, I think it was KHOV. It was $299 for year 1, $399 for year 2, and $499 for year 3's $230. Now let's be careful about that. The APR, which is the annual percentage rate, which they have to report, which is the actual effective rate, was actually 5.75. So when you look at that compared to today, that is that 1% lower. And so that effective rate does have something to do, but you're seeing some more of these, don't get nervous, like back in the day before before the Great Recession. We had a lot of the ARM rates. You heard them, the adjustable rate mortgages. That's essentially what these are. But let's be honest. A 5.5, 5.75 interest rate, it's not horrible. We had 5% rates in before the Great Recession. So as I was telling a client of mine, we've gotten so addicted to 3% interest rates for so long because they were around that's what the norm is. But listen, let's get back to these buyers. So these lower income buyers, it's giving them some breathing room to have these options that builders are paying to play. So instead of having to look at the mortgage payment of looking at it being like $3,200, $3,300 a month, they can get into these more affordable houses, particularly in sort of the Midwest, for $2,300 a month. That's the difference between they can make it happen and they're ready, and really the difference between we want to do this and we're actually, let's go do it. So that's where we're starting to see a little bit of that, and I think that's getting out in the marketplace where it's starting to increase the search activity, the saving activity. So lenders are getting on board too. Builders are partnering up, and they're creating layered incentives that make it feel more like back to 2021 pricing without slashing. I was going to say without slashing margins, but margins are adjusting to what I think we're going to see as the new norm for margins. I think rather than seeing margins in the 20 to 25% range, I think we're going to, for the next couple of years, 26, 27, margins are going to be more in the 18 to 20% range. That's going to be the sweet spot. And a lot of gloom and doom about the stock market. And yes, all of the builder stock prices have taken a big hit. At the end of the day, if they stay the course, keep doing what they're doing to sell homes, keep working on affordability, and stay consistent with these 18 to 20% margins they deliver, the stock prices will come back. So another interesting is, according to the NAHB, the National Association of Home Builders, more than 40% of builders in Q2 of 2025 are offering some alternative financing structure, and those builders are outselling their competitors in a huge way. So this number doesn't surprise me at all, because as we talked about, it's not cheap. Pay to play. Buying rates down from the 6.75 where they're at today to get down to like a 4.99, let's just say, which is like really kind of the sweet spot, could cost a builder, depending upon the final mortgage amount. And that's why there's variables that go into this. What is the mortgage amount? What is the mortgage amount the buyer's actually going to take? Which is, has to do with their down payment, but it could cost a builder, depending upon your market, anywhere from $25,000 to $45,000, $50,000. If you're in Southern California and you're selling, $800,000 homes with a $200,000 down payment, and you're doing $600,000 mortgages, it's a chunk of change. So, but 40% of builders, which is, that's your bigger guys, that's your publics, that's your large privates, your large regionals. They're doing this. They have the money to do it, and they're paying to play. So look, we're going to remind you, what can you do? The inherent demand is there. This backs up what I have been saying for some time, that the inherent demand is in the marketplace. We've just got to find out how to make it actionable. Took that right out of the Lennar earnings call playbook. Literally, they talked about it, like making that demand actionable. And then what are you doing? Like Lennar also talked about their cost structure and really redefining and engaging with everything they can to come up with a new cost structure that allows them to go after affordability. And Stuart Miller even said that, like, if affordability is the issue, we've got to figure out how to evaluate every aspect of our business so that we can be more affordable. And then he said it's an industry problem. I really, a lot of respect. He didn't say this is an interest rate problem, because I agree with him, because I would argue that current interest rates where they sit, we've always had point buy down sets, even back in the day when interest rates were 3%, 4%, 5%. You could use points to buy down a little bit. The problem is
Going from, let's say, 699 to 499, 2% down, or even 399, which some builders are doing, that's not the normal. The normal is typically buying your rate down a quarter to a half to most 1 point. Okay. But right now, what we're talking about is buying our rates down a point and a half to 3 points. That's not normal. So, what else are you doing? Like Lennar talked a lot about their core product where they're really focusing on efficient design. I recently helped a builder do this where it's let's rethink everything about how we architecturally start from the ground up designing a home. Let's talk about product strategy. Builders are getting sharp. I love seeing this. This is near and dear to my heart. It's not just about offering a smaller home, but which is good. Be smart with your footprint. It's about offering smarter homes. I'm seeing Lennar floor plans with open spaces that feel bigger than they are, flex rooms that serve as office, playroom, hobby, so multifunctional, areas all in one.
Think livable, not luxurious. Okay.
Um, and buyers want value, not fluff. Builders who combine affordability with lifestyle, those are the ones that are seeing foot traffic pick up. People aren't chasing granite anymore. They're chasing financial peace of mind and long-term functionality.
Does that mean if you're selling a house with
A laminate countertop in the kitchen, it's going to sell at the same rate as your competitors who have granite? No, but we want to be smart. I mean, I see builders that are still doing, higher end quartz as a standard. I see builders that when you look at their design, their interior design has, 15 interior doors when for that footprint and that bedroom count, they could get away with 11. That four doors, depending upon your market, is $500 to $1,000 on the cost of the home. Put the margin you need to make on that, your overhead, and it's working against the affordability, which when I worked at Meritage, Philippe Lord, the CEO, used to have this thing that price is the ultimate amenity. And I think that rings true now more than ever.
All right, let's talk real results.
Um, I had a builder the other day, they rolled out the new entry level series with the 3-2-1 buy down, and included a refrigerator and a blinds package. And dude, sold 9 homes in 10 days. They weren't investors. They were school teachers, healthcare workers, parents, trying to get to lock into something steady before the next school year. So this is a story I just read about, and this is what we're seeing is like if you think about also we talk about these including the refrigerator and the blinds package. A lot of builders historically the refrigerator is optional.
That could be a whole episode on why we talk
About why that is the case, why it's because people get used to their refrigerator, they like their refrigerator, or just because builders can. A lot of builders also typically the backyard is not landscape, but builders doing this where they're putting in the blinds, the things that buyers are going to need and want after they close, but once they close on a home, they don't have a lot of liquid cash left over. So you start doing these certain things where you're combining, let's say, just a finished, completed home, move-in ready type situations with financing options that they can get the monthly payment to where they want it to be before the school year, and boom, you've got a winning formula to make that inherent demand actionable. It's not magic. It's how you put the program. Are you messaging right? Are you packaging it right? And are you listening to what buyers are actually
asking for from a need perspective. Okay.
You need a refrigerator. You don't need a quartz countertop. You need a countertop, but you don't need a quartz countertop, and you need a refrigerator. Okay. Do you need blinds? That one's kind of a little bit on the fence, but people like blinds. They like privacy. So, there's certain things. A washer and dryer. You need a washer and dryer. Put that in your package. Leverage your buy price from your supplier because you're going to put them in every home, and then get some creative financing. All of these are pay to play. So you're not... don't try to give them things we know they can't afford, because that's just either going to like squeeze your margins or create an environment where they can't afford the monthly payment. Keep it simple. What do they need? They need a refrigerator, they need a washer and dryer, they need their landscape in their backyard done. So do some very simple, low cost things where you leverage your volume to put this in place where you're, hey, I'm going to do 100 homes a year, Mr. Landscaper. Give me a landscape package where we can include it in the home and I can sell this at a lower interest rate. Work with me on this because it's good for you. If we build and close more homes, it's good for us. If we sell more homes, just work on it. So, removing these barriers, whether, however you're doing it, pay to play, the mindset shift we need across the board is stop waiting for the Fed to fix things for you. Start asking how we reduce the friction. Is it pricing? Is it finance? Is it product mix? Is it the customer journey? Are we taking some of these newer first-time buyers and I was on a website yesterday. My goodness, it was the most complicated. First to mention literally within 60 seconds, 3 pop-ups that popped up. How long it took me to get to the floor plans with pricing page. I was guessing to get there. We've got to make that initial customer journey from the website work better in our industry. Home builders are notorious for having horrible websites. What I saw yesterday proves that that's still alive and well. As we talked about, people still want to buy homes, but you've got to meet them where they're at. And then some these days. You got to meet them where they're at with what they want, which is some of these included move-in ready features, and get them to an interest rate that gets them the payment they can afford. So I believe that your product design is going to get you there. We help builders. We've been helping builders for years lower their direct costs by $2, $3 to $10 a foot in product design. Okay, so reach out if you want to hear more about that. And then also that Mortgage Bankers Association, we'll put the link in the show notes for that article so you can read through that as well. And look, the data is backing all of this information up. Just to anchor this, here are some key takeaways from the Mortgage Bankers Association application survey. Mortgage apps are steadily increasing in Q1 2025 from Q1 2025 lows. Not rockets, not hockey stick, but they are increasing. First time and move down buyers are leading this charge. Builders are using buy downs and they're using these buy downs on these mortgages to see the most traction. And smarter floor plans are creating better conversions, combining that with the lifestyle, even if you've got to get creative with where you're putting them. If you can't afford pools and parks within the community where you have your locations. I think this is going to come in a key way in places like Colorado that are having a really soft market right now. But Colorado in the United States, it's notoriously, we've known this for a while, one of the best states for the inherent lifestyle that comes with living there. And I think builders need to get back to focusing on affordability and getting buyers in that environment of lifestyle that their state offers. Other states can do this as well too. Whether you're like, I was just talking to a friend of mine the other day, and he said they're thinking about moving to Lake of the Ozarks, Missouri, because of how beautiful it is down there. Beautiful trails, outdoor. They're very in outdoor spaces and stuff. Every place has that. Lean into that, market that, and tie your community to some of these local amenities that are already there that you don't have to pay for. So that's the quote that stuck with me. Builders who combine affordability with lifestyle are starting to see the foot traffic return. We're not selling square footage anymore. I know it's still something we've talked about. You're going to see realtors are going to go out and they're going to calculate the dollar per square foot, and that's how they're going to benchmark one community to the next. But we're seeing more of just how do we get buyers an option that they can afford that has the things that they need. That might be a 3-bedroom, 2-bath house instead of the 4-bedroom, 3-bath house. But it comes in at a number that they can afford, and it gets them into home ownership. We're seeing some stability in terms of these buyers are slowly coming back, and it's been consistent for a few months. and they just need a home that fits the lifestyle they actually live. Okay. They don't need the 5-bedroom, 3-bath house that's overpriced anymore. These are first-time buyers and move-down buyers. So if you're catering to them, you're going to see some results. So don't just take our word for it. You can pull up the latest reports from, as we said, we'll share the note, the Mortgage Bankers Association weekly mortgage application survey. We'll share the Redfin housing data and the NAHB housing economics. You put it all together, it paints a very clear picture. The new American dream is not gone. It's just reshaped. It's a bit smaller. It's being smarter, more savvy, and it's more financially discerning. So you got to get smart how you pay to play. And, are your floor plans tight and right so that they're giving the buyers what they need, so you're keeping your costs down? That's where you got to start. Then what are you doing with creativity of how you pay to play in terms of incentives on offering those things that buyers need for inclusions, refrigerator, washer, dryer, blinds, rear yards? What are you doing with incentive dollars to get creative mortgaging, to get monthly payments down? What are you doing with incentive dollars on closing costs, other things? Just get smart about it, but you got to start with a very thoughtful design of a home that will build at a great cost. If you're a builder, you're a sales pro, you're a trade partner, now's the time to lean in. Buyers are out there, the ones who've been holding back. They're watching, they're waiting to feel seen, understood, and they want to feel like builders are trying to help them solve their need, okay? So if you keep focusing on what they want but they can't afford, we've said this before, it's like trying to sell a Ferrari to somebody who really is in the price band for a RAV4, okay? Sell them a RAV4, design them a RAV4, get them a RAV4, explain why it's the best, and get that RAV4 to them quickly, efficiently, and for the best monthly payment. Be the builder who shows them the path to get to that home ownership. That's the recipe to win. And let's get through 2025. And if you do that now, I'm not saying 2025 is going to be the best year ever, but if you start focusing on that now to get through 2025, you're going to set yourself up for a great 2026. That wraps today's episode. Hey, if you like this episode and you like what you hear from us here, please hit the follow button or subscribe button on the podcast. It's what helps get it out to more folks, more people. Check out the show notes for the links to the articles we mentioned, and please share this. We know other people need this. We want to bring smart design and discipline back to the home building industry so that home builders can preserve as much of their margins as they can. Trade partners can continue to show up and build houses, and home buyers can get the house that they need and, move in before the school year starts. So catch us next time on The Builder's Mindset, where we don't just build homes, we build futures. We appreciate you. Thanks for showing up, and have an amazing day.
You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets.